The Chinese don't want to end up with a bunch of rubles or a bunch of yen or a bunch of euros. Never mind a bunch of pesos or reals or illiquid, unconvertible currencies. So the idea that there would be short-term settlement between countries in their domestic currencies outside the dollar, but then that currency could be sold on a Chinese exchange for gold, so that ultimately the debt settled in gold, I think has some merit. It has merit until it gets too big. Because once it gets too big, nations are constrained by honesty. There is not enough gold. And those countries do not want to end up with the junk paper that each other issues. I suspect over 10 years that the dollar will do okay against a basket of other currencies. My friend Doug Casey is famous for saying the US dollar is the worst currency in the world with the sole exception of all of the others. And all of the ills that I see plaguing the US economy, or at least most of the ills I see plaguing the US economy, I see plaguing other economies as well. Too much political power, misallocation of capital, too much debt. I think the absolute purchasing power of the US dollar falls by 75%. I suspect 10 years from now, if you compare it with the euro or the yen or the Canadian dollar or the Australian dollar, the US dollar will look okay. I think we're heading into a period of currency volatility. And I think the decline that you've seen in the dollar versus other currencies is a function of the eroding market share as a reserve currency, rather than a comment on the competitive valuations between economies in various countries. The U.S., for all its sins, and I'm American, I know the sins, for all its sins is still 23% of the world's savings and investment assets, and it is still the deepest, most liquid, and some could argue the most innovative economy in the world. It's also an economy whose voters and government are strangling themselves.
The dollar's decline against other currencies is less about the U.S. losing ground competitively and more about its share as a global reserve currency eroding. Foreign central banks are increasingly scrutinizing whether large dollar-denominated portfolios remain safe in an era of sanctions and geopolitical risk. Despite this, recent data shows the dollar still dominates global reserves, roughly 58% in 2024. The inertia is strong, but the trend suggests the greenback's privileged position may slowly unwind.
I do. I think foreign central banks have been, in effect, forced into gold for two reasons. The weaponization of the U.S. dollar, the idea that the U.S. government seeks to superimpose its political preferences on people around the world via the SWIFT banking system, U.S. sanctions, or in the case of Russia, as an example, simply stealing their U.S. dollar-denominated assets, means that countries that think that they might have a policy dispute with the United States are thinking again about storing their wealth in an instrument that the U.S. government can cancel at its whim, like it did to the Russians. The second thing is that the U.S. dollar, or at least the U.S. Treasury, is a lousy deal. If you believe, like I do, that arithmetically the decline in the purchasing power of the U.S. dollar isn't measured by the CPI, which I think is a silly index, but rather declining at some much greater rate, I believe 8% is an example, then the value associated with the U.S. 10-year Treasury is pretty simple. It pays you 4.6 in a currency that's declining by 8. Meaning you aren't making 4.6, you're losing 3.4, compounded for 10 years. You give the U.S. government $100,000, and after 10 years, they give you back less than $60,000 in purchasing power. If you combine the weaponization with the weaponization of the dollar by the U.S. government with the fact that arithmetically it's a lousy deal, no real surprise that the foreign central banks are disintermediating out of U.S. dollars and in favor of gold.
The United States remains a deep and liquid financial market, with around 23% of global savings and investment assets and arguably the world's most innovative economy. Yet this strength is undercut by self-inflicted constraints, political gridlock, runaway fiscal deficits, large entitlement burdens, and systemic misallocations. The dollar may benefit from the system's momentum, but the underlying economy is increasingly weighed down by choices that compromise long-term resilience.
I think if I was them, you'll notice that when foreign central banks are diversifying out of out of dollars, they aren't diversifying into other currencies. That's because as little as they trust the U.S., they trust each other less. The Chinese don't want to end up with a bunch of rubles or a bunch of yen or a bunch of euros. Never mind a bunch of pesos or reals or illiquid, unconvertible currencies. So the idea that there would be short-term settlement between countries in their domestic currencies outside the dollar, but then that currency could be sold on a Chinese exchange for gold, so that ultimately the debt's settled in gold, I think has some merit. It has merit until it gets too big. Because once it gets too big, nations are constrained by honesty. There is not enough gold. And those countries do not want to end up with the junk paper that each other issues. There is no government in the world that can afford to go on a gold standard because they all spend more than they take in. And gold is actually honest money. I think what the Chinese are looking to do is reduce the BRICS need to have gold as a medium of exchange. That's very different than ultimately using it as a store of value, because that constrains the issuers of all these bogus currencies. Where would Russia get enough gold to settle their obligations with China and Japan and the European community? Where would Japan get enough gold to settle their obligations? You get my point.
Given the backdrop of dollar risk and geopolitical leverage, many foreign central banks are turning to gold as a hedge. The use of sanctions, freezing of dollar assets, and dominance of dollar-based settlement systems have ratcheted concern that governments outside the U.S. may seek reserve alternatives. Official data emphasizes that while gold holdings have grown, the trend isn't always directly linked to a reduction in dollar holdings, except among a few countries. The logic: gold carries no counterparty risk and cannot be frozen by a sovereign power.
Former reserve currency was being inappropriately handled. The U.S. government violated that exorbitant franchise by weaponizing the dollar. And the second reason is that the U.S. Treasury is a lousy deal, arithmetically. These foreign central banks aren't doing it out of sport. They aren't doing it because they dislike Trump. Well, maybe a little bit. They're doing it because we've left them no second choice. Some years ago, I used to trot around, in particular, Asia, selling Sprott financial products, but in particular our precious metals trusts, to sovereign wealth funds and stuff like that. And I remember very clearly dealing with what are in effect Asian sovereign wealth funds, and looking at their massive holdings of U.S. Treasuries, massive holdings, and saying, as an American, this is very flattering. You guys send us all kinds of cool stuff, cars and computers and stuff like that, and we send you back dreams painted on pieces of paper. I mean, it seems like a really good deal from my point of view, but doesn't it kind of feel, and I said this, doesn't it kind of feel like a lie to you? And I remember a counterparty saying, ultimately, Rick, what you say is true. Oh, he didn't say Rick, Mr. Rule. Mr. Rule, ultimately what you're saying is true, but yours is a deep and liquid lie, unlike the other lies that we're being told. I asked the same guy, do you trust us? And he said, no, but we trust you more than we trust each other.
Treasury securities, long regarded as the ultimate safe asset, are unattractive if one believes the dollar is losing purchasing power at perhaps 8% a year. By that calculation, earning 4.6% on a Treasury is in fact a net loss of 3.4% annually in real terms, compounded. Meanwhile, the official CPI inflation metric is widely criticized as understating true cost pressures. The implication? Many savers are losing purchasing power even while holding assets that are traditionally risk-free.
First of all, when you talk about gold and silver at all-time highs, I don't want to nitpick, but they're at nominal all-time highs. If you use constant dollars, both gold and silver are substantially below their prior all-time highs, and people need to understand that. You're talking about the nominal value of gold and silver priced in U.S. dollars, which themselves have deteriorated very substantially since those former highs were put in. We have to deal with that. But in terms of a rate cut, if you believe U.S. government statistics, which is to say, if you believe that the CPI is an accurate representation of the deteriorating purchasing power of the U.S. dollar relative to a basket of goods and services, there's room to cut interest rates. Mike Maloney refers to the CPI as the CP lie, which is to suggest that it's a very, very erroneous measure of the cost of a basket of goods and services. I would invite your listeners, particularly your North American listeners, to compile a mental index of the cost in U.S. dollar terms of items that sustain their family and compare the year 2020 with 2025. Compare the price of energy. Compare the price of groceries. Compare the price of rent or home mortgages or health insurance. Pick one. Note, too, that the CPI doesn't include tax. Try and find somebody whose taxes have gone down in the last 5 years. If you believe that, as I believe, the deterioration of the purchasing power of the U.S. dollar is more like 8% a year, what happens is that declining interest rates increase the negative yield that savers enjoy. Enjoy is a frame I use guardedly. It signals something else to the world. It signals to the world that the U.S. society has decided not to care at all about the integrity of the U.S. dollar. It represents political capitulation and an ignorance of economic reality. I believe, frankly, that short-term politics is more important in the United States than honest economics. So I'm fairly pessimistic about the outcome of a circumstance that you described. I'm not an economist, so I don't know if a weaker economy is nigh, although the oil price and the copper price would suggest that demand is much weaker than people think it is. But I do absolutely agree with your suggestion that if we have a slowing economy, or worse yet, if we have a decline in confidence that would, as an example, spark a 2008 style event, that the policy response to that would be both artificially lower interest rates and massive quantitative easing. And Alexei, it's important to understand that if you or I engaged in quantitative easing, it would be called counterfeiting. We would be put in jail. If Congress engages in counterfeiting, lowering interest rates, they're widely regarded as heroes and reelected. It's an odd world that we live in.
Beyond currency concerns, the price action in industrial commodities suggests demand is far softer than conventional narrative. For example, a 7% supply drop in copper recently, yet only a 5% price rise, suggests weaker demand. Measuring assets, liabilities, and living costs in gold rather than dollars paints a picture where many items appear cheaper today than in 2000. That insight suggests that despite the feeling of inflation, economies may be experiencing a form of deflation in gold terms, a nuance often overlooked in dollar-based thinking.
Precious metals continue to run faster. My suspicion, and I'm not an economist, Alexei, I'm really not. I'm a credit guy, really. My suspicion, particularly around the copper price, is that real world demand is much softer than people think it is. In the last year, we've seen 7% of the world's copper supply come offline. Cobre Panama, Grasberg, Kakula, and the copper price is only up 5%. Understanding that prices are set on the margin, a decline in supply by 7% in other periods of time would have yielded a much stronger price rise. My working hypothesis is that near-term demand for industrial commodities, things like oil, natural gas, and copper, in the current period is much weaker than we think. You can have supply shortfalls if you have a demand shortfall, and the price doesn't go up. Pricing it in gold is an interesting topic. I have kept an alternative ledger, informal, myself since the year 2000, where I try to value my income, my assets, my balance sheet in gold as well as in dollars. And if you do that, it's amazing how cheap things are. Your food is cheap. Your gasoline is cheap. Your labor is often cheap. If you measure the cost of goods and services in a medium of exchange that is actually a store of value, bear in mind the gold price in nominal terms is up 12-fold. What you find is that a whole range of things have fallen, in some cases, fairly precipitously in price in the period 2000 to 2025. Unfortunately, most of the people who listen to this interview will be mad about that statement because they forgot to save in gold until the gold price broke out. They were speculators, not savers. I have been, although in hindsight, not aggressive enough, but I have saved in gold for 25 years, and I've maintained liquidity in US dollars. Those are very different statements. The consequence of that is not just copper and oil, in other words, not just commodity, but all kinds of things measured in a constant, which is to say gold, are cheap. One could suggest that for many of aspects of our lives, although it feels like we're living in an inflationary period, we're living in a deflationary period.